This video forms part of a possible series of economic commentaries and is going to begin with a short discussion of the role of the financial arrangements for monetary policy and the role of the Bank of England. The Bank of England is now engaged in the sale of government debt, which is called gilt-edged stock, that is acquired during its period of quantitative easing, also known as open market operations. This had involved the purchase of short-term government debt on the bond markets, reducing supply relative to demand and thereby raising their price and reducing the returns on the bonds, that is, lowering the interest rates. Thus it contributed to monetary easing in order to stimulate the economy during COVID. At the same time, the bank was adopting an expansionary monetary policy, creating credit for the government, that is, it was printing money and thereby acquiring its own stock of government bonds. This credit allowed the government to pursue a complementary expansionary fiscal policy, adding demand to a faltering economy through government spending. The post-COVID period has been characterised by inflationary pressures. Although some commentators like to blame this upon QE, it is more likely to be driven externally by the significant increase in international energy prices, which has reduced the UK's collective standard of living. The consequential industrial conflicts are a predictable result of various groups of employees attempting to minimise the reduction of their share of a smaller national cake. The bank is now attempting to release its accumulated government debt into the gilt markets, that is the bond markets, lowering prices and increasing yields and returns. General interest rates linked to the gilt markets, which are extensively and problematically held by UK institutions, have thus risen in keeping with the government's tightening of monetary policy. Unfortunately for the taxpayer, the sale of this government debt will result in paper losses as the bank is selling into a market with falling prices. However, this is less relevant than the impact upon government borrowing of the higher interest rates being paid to private holders of government debt. It also raises problems for the other arm of monetary policy, the use of the bank rate. This is the rate of interest offered on the required deposits of the commercial banks with the Bank of England. A desire to reduce interest rates through reductions in the bank rate must be compatible with the impact upon the bond markets of open market operations, since reducing the bank's holding of government debt by its sale into the bond markets must increase the interest rate that is offered, that is, lower its price for those bonds to be absorbed. The question I wish to raise is why such debt should not be held on the accounts of the Bank of England. As a public institution, any interest payments from the Treasury will be merely a paper liability between the two public bodies. The objection to such institutional arrangements was that which justified the independence of the bank, that it constrained the government of the day from excessive borrowing, which would create inflationary pressures through printing too much money, that is, excessive monetary expansion. Clearly a framework to constrain governments from this temptation is necessary, perhaps a legislative constraint relating this credit creation to the rate of inflation or level of unemployment as a proxy for the state of the real economy. But the current system, utilising the gilt-edged market, comes at significant cost for the taxpayer in payments to private holders of gilts and their gains from price movements in the bonds. Government economic policy always has as one of its objectives an economy operating at full non-inflationary capacity, and both fiscal and monetary policy are the primary instruments in achieving this objective at the macro level. Interest rate policy should instead focus directly upon the use of interest rates offered on compulsory special deposits at the bank by financial institutions. Historical institutional arrangements should not be beyond examination, even in the face of existing vested interests, if the optimum system of economic management is to be achieved in a mixed economy.